still join in when they arrive. So I'm going to start from the beginning. Assalamualaikum and good morning, everyone. Thank you, everyone, for attending this workshop today. I'm sure that there are a lot of questions and a lot of clarity required for the new RBCT guideline that has just been released. So we also want to thank, first of all, APTB for allowing us to use this beautiful hall. And then we also want to give a big thank you to Milliman for agreeing to conduct this workshop for us. So together here with us today, we have Puan Farzana, the Principal and Consultant Actuary. We have Alphonse Chai, and we have Yu Wei Lim. And they, for the next maybe 1.5, maybe even 2 hours, going to play havoc with your brains. Okay. So without further ado, I would like to pass the mic to Puan Farzana.
Good morning, everybody. Very good to see all of you here today. I think first of all, I wanted to thank Lynn and MTA members for organizing this event for me, for Milliman, and thank you to all of you for coming here on an early Wednesday morning. I understand you were here earlier for the breakfast, for joining us this morning. So the intention for this morning is really to share, I guess, describe at a high level the differences between the draft RBC2, as I call it, versus the existing RBC. And this is focused more on the family operators. And there'll be a separate session for the general Takaful operators likely next week. So we've been given timelines by the regulators. This was just issued in June 2024, so just under 2 months ago. And it looks like there will be quantitative impact studies, the second one, that's due end of this year. And then we will have a parallel run in 2026, followed by implementation by 2027, if all goes to plan. So quite a lot to do in the next 1 or 2 years. This is not just a case of implementation, it's a case of understanding your impact on your capital management, impact product strategy, and business planning. So what we will cover today is just really the key changes. So it is not intended to be fully comprehensive, but really highlighting the key changes. You can see it's quite a long document. So there are areas that we will highlight, the areas that I think people should be aware of. We'll also highlight potential impact on modeling and operational. And I know always that when you speak to management, they'll always say what's the impact. And I'm sure all of you are busy working on the impact. We as well at Milliman have been working on impact as well. So we can share some high-level analysis, but we will also be holding an event at the end of this month, on the 29th August. I think invites has been sent out to all companies. And I think most of you have responded. And if you haven't gotten an invite, let me know, but we are limiting it to about 2 per company with the intention that we hope to be generating some discussion during our Milliman forum. So we will break our presentation this morning to 4 parts. So first is really talking about the changes in the investment liability. Then we'll talk about changes in how the TCR is calculated, changes to TPA, and lastly, the key takeaways. So we've got Marcel, who will be speaking on the first part, followed by Yue, and I will close at the key takeaways. So let me pass on to Marcel.
Everyone, I'm Marcel, and I'm a consulting actuary in Milliman. So the first changes we see in RBC2, one of the big ones would be the discount rate. So what we are doing right now is basically we just take the government investment issue with the QII up to from the first year up to the last liquid point, which is year 15. So it's after year 15, it's a flat spot rate. But in the RBC2, we are now adopting a 3 pattern. So it's going to be the same for the first 15 years. And after that, from year 15 to year 6, Smith with some extrapolation. And then After year 60, we're going to use a long-term for rate of 5%. And for the discount rate, there's not going to be any adjustment. So we are not going to adjust it for any volatility, matching adjustment. Also, you don't have to consider maybe liquidity premium. So you just take the discount rate as it is, and you have a long-term for rate of 5%, and then between 15 to 60, you just do an extrapolation. So there's some implication here. So currently, what most companies are doing for example, in your PIF, you would project your fund at B, but in discounting, you actually use the risk-free rate. So there's some mismatch here in current RBC, but in RBC2, it's actually aligned so that in your PIF, you would also project it, your investment return at your risk-free rate, and then you are also discounting it at risk-free rate. So here we are showing the graph between year-end 2023 for our current RBC and also RBC2. So in the dark blue line, is the current RBC. You can see after year 15, it is a flat spot rate. And then we have RBC2, which is extrapolation to a long-term rate of 5%. So you can observe after year 15, it will slowly converge to long-term rate of 5%. And just a side note, so since we are using like extrapolation between 15 to 60, and then there's a long-term period of 5%, we are sort of expecting the long-term liability to be less volatile in your reserving because since the long-term period is 5%, then you just do the extrapolation. Current RBCs, after year 15, you're going to use the same spot rate. So it might be volatile depending on your year 15 spot rate. But since you are doing an extrapolation, and so we have a fixed long-term spot rate, we are expecting it to be less volatile now for long-term liability. And here is showing the shock between interest rate up down on RBC and also RBC2. So on the left-hand side here is the current RBC. Just by looking at comparing the graph between current RBC and RBC2, we can see that for the first 10 years, the shock is actually smaller in current RBC, whereas you observe a bigger gap for first 10 in RBC2. But after first 10 years, the shock for RBC2 is smaller, whereas the shock for current RBC is actually bigger. Yep. And then the other part we'll talk about is about non-usual reserves. So currently there's there's a need to do and future financing. So what most of the company do is at any point of the period when cover reserve, you just should with it, and then we do a declaration to find what's the current reserves. So in the market, this is probably known as mentioned in RBC2, meaning we can just use GPV reserves and then just allow for the negative reserves. So what will happen is we potentially could see some negative reserves to offset some of the positive reserves. But if you aggregate your reserves at fund level, you will still need to zeroize it. You would need to floor it at zero. But for RBC2, if you lost any negative reserves due to the flooring, you can use 50% of that negative reserve as your TCA. So in your balance sheet, if you have a negative reserve, you're going to float at zero. However, it's going to reflect in your TCA instead. Yeah. Okay. The next one will be options and guarantees. So in current RBC, obviously, there's no one is measuring this. No one is running any kind of stochastic projection. But in RBC2, there's a mention about if you think your TVOG, which is option and guarantees, are going to be significant, and if you think using stochastic or deterministic, the results the difference is material, you have to use stochastic projection to measure your TVOG. But again, there's no clear interpretation of what's significant or material in this context. So you have to come out with a way to interpret this. But we understand in IFRS, you probably have done this exercise before. So if you are already measuring your T-bar at IFRS 17, that could be a good start to come up with whether it's significant or material. But like I mentioned previously, so the discount rate is actually not adjusted for anything. But in IFRS 17, you actually adjust it for maybe to the premium. So if you measure T-bar under RBC2 and under IFRS 17, it could be different. So you have to note the difference here. So the other thing is some of the company for now, you just do a simplification whereas in T-bar you use a factor approach. So for example, if you measure it as 3% of your bell, so for the next 1 year, you actually don't run stochastic projection. You just apply a 3% of bell, then take that as your T-bar, which we call it a factor approach. But this is not allowed in RBC2. So you have to use stochastic projection for your valuation. And since we see RBC2 is trying to be consistent with RBC 17, if you think T-bar is going to be material and be significant, you actually have to use stochastic projection for RBC2. Okay, the next one is risk grouping, homogeneous risk grouping. This is kind of a new concept introduced under RBC2. So actually, most of the company are in some way maybe doing risk grouping, but in current RBC, there's no explicit mention about risk grouping. So I'll just roughly go through what risk grouping is. So when determining a, for example, your lab selection of different product, some of the company would actually do it at mini fund level. So at fund level, you take labs, you observe which one gives you the highest discharge or higher reserves. So maybe it's a lab selection or lab selection, and you apply it to all the products. So some of the company actually do it at fund level of simplification. But from some company, it's also, we also observe that you actually do it at the product group level. So you group your product into different grouping. And then for the lab direction, you determine at that risk. So for RBC2, it mentions what you have to consider when you group those products together, which belongs to the same homogeneous risk groups. So for example, you have to consider what the risk drivers, which includes the features for the product and whether there's any options or guarantees in it, and or what's the nature or duration of the exposure for the risk. And then whether there's, I think one interesting here is that we have to consider the risk shared between the policies holder. So whether there's any crop subsidy or any surplus participation, we have to consider that as well. So with this new new standards, for obviously we cannot do it at fund level anymore because the fund level wouldn't fit into the private sphere. You could probably do it at, or maybe not IFRS, if you have an ICG grouping IFRS 17, but it's going to be very complex because in IFRS 17 you have to consider total year, you have to consider about profitability, which is not relevant in IFRS 17. So you could look at how in your company, how would you do your risk grouping and whether it fits into this current definition of risk grouping. And then for, you could also face some complexity when you want to group basic and rider together. Because if you group basic and rider as a separate risk group, or you group basic and rider together as a risk group, it could give you different lab selection for this grouping. Then the other thing is for in the RBC2, the appendix also, this is, I think, something nice to have. When you consider about your mortality or morbidity experience, you would also look at the risk grouping. And then the last one is if you consider PRF surplus in the shareholder reserve or BEL as an income, you need to have a counterpart in your PRF reserves as an outgo. So there's no mismatch here. So because we know for some of the company, when they have PRF surplus as an income, that's not always the case. They have an outgo in PRF reserves. So you have to allow for, you have income and outgo as an liability have to be matched in this case. I'll pass my time to review on the sessions.
Be happy to take questions. Any questions, comments, feedback from your own observations as well? Very happy to discuss this one. Correct. So that will be covered in the TTA section, but you're right. There's a 50% recognition of negative reserves in the shareholders fund and 100% in the PRM fund. You're right. So moving from a sterling reserve to GPV, you may see negative reserves emerging, and that negative reserve, either 50% will be allowed as capital available, or 100% of the PRF as capital. Any other questions? So there's two parts. You can either reserve for it as your BEL in the PRF, or if you don't reserve for it, it is a negative adjustment to your TCA. So regulators giving you an option whether you adjust on the BEL and therefore capital required part, or do you adjust on the TCA. Comments before we move on? Okay.
What's the importance and the best limitations on setting what's the importance and the potential implications for how to set or how to put the products together complexly?
Yeah, I think the first indication will be on your model side. So for example, if your model currently is taking the next of four groups as the result, then that means that you're taking the right direction at the policy level. Then that is not aligned with what the standard required, where the entire HRG will need to be at the same direction. So you will need some enhancement on that. That is on single product level. Then you should also consider the rider as well. So for example, you might model the rider attachable to multiple basic product under the same codes. Then you need to allow the correct direction to change based on the basic of that rider itself. Any other question? If no question, then we move on to the next section on the TCM. The first thing to note in this RBC2 is that there is a new supervisory intervention level. So previously it's 130%, but now it's set to 100%. In the previous RBC, there is no clear indication that what the solvency what the solvency supervision intervention level imply, but now it's quite clearly indicate that this will be 1 in 200 over the next 1 year. So it's similar like solvency 2. Then this 100% at the entity level is the only requirement mentioned in the RBC2. So there's no requirement to maintain the fund level high at 100%. And there is no other percentage things. But the bank doesn't limit itself, so it might, based on the writing in the EV, it might introduce future. It might introduce more. If So under the current RBC, the recharge is not as the risk level is not explicitly mentioned. And under the current RBC is probably I would say is probably equal to 99.5% confidence level or 1 year periods. And in the current RBC, the total TCR is what you believe is the sum of credit risk charge, market charge, interest rate, risk charge, operating uh, for the map of the RBCT. There is no diversification benefit, and for the insurance recharge, you will shop everything simultaneously. For the RBC2, the SDCC is removed and it will replace with allowance for max lab under the labs risk in the insurance recharge. And the TCR it will still be some of the factor charges, but with allowance for diversification within the insurance risk and also the market risk, and also in the credit risk, technical risk, market risk, and also the insurance risk. So next slide. Yeah, so this is a clearer table of how the diversification works. So on the top side, you have the life insurance risk, cover the mortality, lapse, longevity, expenses, the morbidity and medical. Then you will diversify to a single life insurance and the full risk component. Then under the bucket, you have the interest equity, currency, non-default spread. The non-default spread is a new thing. Then the property asset concentration. Then there's also changes to the asset concentration as well. Then on top of that, there's a new catastrophic risk and the credit risk. Then you will diversify all these components to PCI for the RCC. Then from that you add on the operational risk and that get your total company percent. Yeah, so the this approach is actually quite a standard approach. Is so very similar to what is under what the standard formula under the Solvency II. And yeah, we will cater for the life insurance, the public and corporate risk, market risk, credit risk, the public risk, which new one, the operational risk, which have a change in the formula. We will go to that later. Then what is one of the key changes is the removal of the surrender value factor charge. So under the current RBC, you will calculate surrender value factor charge as the change in the asset minus the change in the reserve. And the total factor will be the max of the SBCC or the sum of the individual reserve. So the SBCC removed and replaced by the asset research. Within the life insurance research itself, so there's a new max lab risk. Then there's also a new critical payment risk. So this is now separated from the current morbidity and is separated and it's also mentioned quite a lot in ED. For example, you can allow for the impact of the medical reducing in the event. Then for the expense recharge, there is some such changes where now you need to allow for the 1% and also the new catastrophe research. Yeah. This table just show the summary of the changes. So we can see that for mortality, we know that mortality most of the rate are actually guaranteed, so it's actually a drop from 40% to 25%. Then for morbidity, it's actually most of it are actually not guaranteed, so it's actually increased from 22.5% to 40%. Then for medical payment, is also typically it's not guaranteed, so it's also an increase to 25%. But now you are allowed to have a management action on top of these structures, so the net impact will be a lot smaller. For REX, it will be reduced to 45%, but there is again another max lab within the REX component, so yeah, it might increase in some way. For expenses, it will be an increase because there is a new 1% inflation to the expenses stress. Then for catastrophe stress, it's a new stress as well, so it will be instantaneous 1.5 at 1,000. 5 plus the 30% increase in the electric payment in the next one. Yeah, so on the market risk charge is one of the key changes as well. So previously in the market risk charge, we will just take a factor of the exposure. So for example, if you have 100 millions of the equity, you will just apply a factor on that 1 million of the equity. However, that the changes here is that in the RBC2, when you are buying the market stress, you will need to consider the change in the asset and the change in the liability together. For example, under the equity stress, there will be back to your buy, or for investment link, there will be back to your liability, and then you will have the you will quantify the equity risk stresses as the changes in the NAV, the set of the liability. Yeah, then on top of that, there's a new non-default spread. For certain component, there is also increase in the risk charges. So for example, equity, there is some changes from 20% to 30%. For property, even from 8% or 6% to 5%. And another key changes is on the CIS. Under the current RBC for the CIS, you only apply the factor based on the component of the CIS. So for example, if CIS is a government bond, you will not apply any. It will not attract any. But under the RBC2, the look-through is mandatory. So you will need to apply the look-through basis. So which means that even if you invest in the CIS, you will attract the interest rate risk charge as well. If look-through is not, there's 3 look-through approach. So the first one is the true look-through, then the second one is a mandated look-through. If both are not adopted, then you will need to apply a fallback approach, which is a flat 20% risk charge. So this will be quite a big changes. Yeah, and I think for most of the Takaful, they actually invest in quite CIS, so it's something to consider. Then similarly for the interest rate risk, it will still maintain at the it will still take the entity back level, and it will take the dominant scenario, whether it's up or down for the risk side and the swap. Yeah, then the interest rate will be the dominant scenario and for yeah, so this table is a summary of the changes in the market risk charges. So if you in interest rate, it's like what Marcel had okay just now. So in the first 10 years, for example, the stresses is a lot higher under the RBC2, and after year 15, the stresses are a lot higher under the current RBC. So that there is a change in the first 10 years. So the after the 10 years. Non-default spread is a new one, so it will be above 5% in spread, but subject to the floor of 0 and cap of 1 EB. For equity, it's a change from 10% to 30%. Then yeah, CIS is previously is a factor based, so 0%, 4%, 6%, but now you will need to apply the look-through. So it will subject to the interest rate and equity stresses above. And if you are not able to perform the look-through, then you will face the 50% stresses. Then for property, it's 8 or 60% to 25%, and no change to the currency. And for asset concentration, it's like a change in the methodology. So previously it's 100% above the investment limits, and now it's starting from 10% for exposure above the prescribed threshold. Then the prescribed threshold is actually just 3%. So it's again it's something to consider as well. Yeah. So now we move on to the credit risk charge. So in the current RBC, you only apply the credit risk charge by the credit rating without looking at the duration. In this new RBC2, there's actually a lot more grading. It actually split into, for example, there's a new public sector entity things. Then for the corporate bonds, it will now look at the duration as well. So this table just shows some high level view. So you can see that the shorter duration bond, it will have lower charges versus in the current RBC, the shorter duration bond, it actually also has the same structures like long-term bonds. So overall, we can see that credit risk should be should be reduced, but of course, it's still subject to your bond mix as well. If you have a lot in the long term bond, then it might not be reduced or in general it should be constant. It should be on the downward trend. Next. Yeah, so this is on the look-through. So like what I said just now, there's a three look-through approach allowed for under the RBC. So one is a full look-through, which is you will need to get the individual listing of the CIF itself, and you apply the stresses accordingly. Of course, that will be quite data intensive and quite troublesome, and obviously, most of the time you might not able to get the data available in first few working days. Then another approach around is the date-based look-through. So for example, if your mandate is 30% and 75% in the corporate bond, and if your corporate bond is with a targeted duration of duration 10 and AA rating, then you will apply the special accordingly based on the mandate. If both option A and B are not available, then you have the fallback approach, which is flat 50% risk charge. Then now is on the operation risk charge. So under the current RBC is just straightforward 1% of the total asset as your ORCC. However, under the RBC2, it will be like a factor based, and it will based on your first premium and your bill and also your management expenses based on whether the product itself is account based or not account based account. So account based account is like the IRB. The account based account for IRB is actually just the 25% of the expenses over the past month. Next slide. Yeah, so just now I talked about the medical business that is from 22.5% to 25%, but in the ED itself, the manufacturer on the stress scenario is actually allowed. So you can actually assume a revising in the stress scenario, then you will not get hit by the full 35% over the projection. So in the ED, a few things have been quite mentioned explicitly for the medical business. The first one is that claim inflation must be explicitly accounted for. So if you are currently using a loss ratio, if you are currently using a concern loss ratio in your modeling, then obviously that doesn't cater for the inflation. So with the inflation, you will need to move away from the loss ratio first. And if you assume for the claim inflation, you must also assume for the increase in the cost of insurance as well for your item. In the ED itself, and also mentioned that for ILP, you can only assume the increase in COI, but not the increase in the premium. So what this means that you will have your COI increase at the medical inflation rate. So for example, if you assume your medical inflation is 12%, then your COI will actually increase by 12% as well. And you cannot assume the revised premium. What this means that your sustainability of the ILP it actually will be cut short quite significantly. So just now, myself also mentioned that there is a change in the high sustainable growth rate to the risk-free curve under the RBC2, and you will need to use the risk-free curve as your annual rate. So that itself already cut short the funding sustainability. Then now with this revising of the medical COI, the sustainability will reduce quite significantly. Then for the Takaful adjustment, so just now Marcel mentioned that if you allow for surplus in the shareholder fund, you also allow for the surplus as outgo in the AIF funds. So okay, so what this means is that if you include the surplus, you should also include the insurance recharge to the shareholder funds. So under the current policy, typically you doesn't include the surplus in shareholder fund expense liability. That's why under the shareholder fund, the insurance risk is actually zero. But if move on to the RBCT, if you include the surplus to your shareholder fund now, then there is a insurance risk component that then you will need to apply. Then for the all the expenses, you need to apply that to your shareholder fund also. And what that means that you will have the insurance risk charge under your shareholder fund. Yeah, the funds. And of course, this will result in additional item, but of course it might have some advantage as well.
Okay, let us pause there for a while. We covered quite a lot of materials, TCO. But I think the key messages is that you've got market risk that's not increasing, equities going up. Even things like CIS making companies to full look through. If you don't have full look through, then essentially you'll be penalized when you charge a higher risk charge effectively. If you don't have that operational ability to look through your CIS. In terms of the life insurance or the Takaful charges, some person on. So yeah, on life insurance and Takaful charges, some parts have gone down, some parts have gone up. But you know, we also have diversification benefits now, which then should actually reduce some of this increase in total capital requirement. So lots of changes. Keen to hear if you've got comments or thoughts.
I'm not sure if you're familiar with the concept called zero constant spread or something. So it's essentially you will discount back the bond cash flow with a constant spread above the risk period that will match back the market value of the bonds. So you will discount back with curve that. Then of course if you just discount back, it will not match the market value, but you can go seek an additional spread above the curve that will match the market values. The spread will be a constant, yes. Yeah. Yeah. So, how is it? Obviously, you will need to do that at I mean not I mean it's better for you to do that at a summary level, higher level, because for zero level it will not give you a representative surface. I mean, I think it should be quite similar with what you are doing right now. So if you are measuring it short term now, then you should be able to argue to short term in the RBCT. And if long term now, then it remain as long. Yeah, I think that's a good question. Yeah, I think the standard doesn't mention that clearly.
So I think the first is about the technical management actually in the medical claim fees. While we can reflect the increase in claim and COI, we are not allowed to reflect increase in the contribution. So it doesn't really reflect the actual cash flow and the requirement of distribution. And it might not really reflect how the business will look like as the first thing, as question. The second one is about giving us the flexibility to reflect the PBL future surplus in the GIF fund. So this thing also, and somehow this will be consistent with the top requirement that you only display surplus after you have to define your liability. Yeah, and surplus is also part of the liability right now. So there's a second item. The third thing is also wanted to clear from Milliman as well. View on only recognizing 50% of the mega reserve as a rate. But when we are taking the discharges, actually the short apply 100% of them.
Okay, good. So I'll take a couple before I pass it on back to Wade. I mean, essentially, I think that I'll start with the last point first on the 50% negative reserves that can be allowed as a TCA adjustment. So I think that is, I think there was a question in there whether we with their proposal. I think that it's worth raising because I do see inconsistency between what we have to calculate as capital required and total capital available. There's also a comment, there was a question that you raised in front about the medical repricing that's being allowed on the cost of insurance, but not on the contributions. So I think this is what we noticed as well, because essentially, if you do that, you increase the cost of insurance, your contributions are unchanged. It just means that sustainability actually shortens quite significantly. So you can actually manipulate it and assume a very high inflation and your sustainability drops and your TCR drops. I think the concept of not allowing contributions is probably not to capitalize your future premiums because it's unclear whether you can get to pricing. My suspicion, that's my personal interpretation. But I think there's this implication that's actually the more conservative your medical inflation assumptions are, actually it actually has the opposite effect on the TCR. What was this? There was another question. The surplus. Yeah, so that's why we thought the surplus, because now it's considered as a liability, I think modeling wise will be quite challenging because we have some similarity. But I think they are trying to match the recognizing the all the cash flows. I think that's the intent. But I think there will be limitations from a modeling perspective. Anything you want to add?
Yeah, just one quick thing is I think you always mixing the reserve to calculating the surplus and the PI well at the same thing. So it might not be the same thing. So the reserve that you use to determine the surplus, obviously it cannot have the surplus. But then once you calculating the reserve itself, then you can just add on the surplus and get it. So it's actually the same concept that your IFRS 17. So if you can get a PIL under your IFRS 17, then you should get it for parts.
Thanks. Probably more observation. First is the technical point. Because the concept is they're measuring the capital over a 1 year horizon, 99% confidence level of value rates. But when it comes to the credit rates, when I look at the capital charges for the different bonds based on different tenure, it seems inconsistent with that 1 year horizon. Because a AAA, whether they expect this more to go, whether there's 1 year more to go, if you look over the next 1 year, it's the same. Should be the same piece of default. But by differentiating it according to tenure, what it discourages companies to do is really to, if you're trying to match your liabilities, but you actually be penalized further for it in comparison to the current framework. So I think that's still the philosophy that paragraph can that. Second, I mean, just touching on what you've got to mention. I think it's on the medical repricing, whether you can increase the contribution or not, it has to fall back to the contract. So if you have a contract that obviously increase in contribution, then it should automatically be reflected. Not then you have the consistency between how you manage your businesses and versus how you actually model for capital as well. I also observed that potentially there could also be challenges with regards to on the spread. Then in comparison to what we're practicing now, it means every single bond group that we have in order to calculate the spread and stress that individually and different funds on different composition of it. So that would be quite challenging. The other observation is also the stress of assets in the BNM. I'm not too sure whether it's intended or not, or probably unintentional. Especially for LP, let's say if funds are invested in equity, stress the equity downwards, we actually just get a shorter sustainability and actually the whole less reserve than what we have given stress. That so in a bit of a dichotomy in terms of that approach.
But I completely agree with your observations. I think, it's important to think it's not just the calculations, there's a lot of operational and modeling implications, not just to actuarial, but financing and recalculate your asset values. I think one maybe my view on the ILP, again, I guess potentially why they are doing that. Again, this is just speculation on my part on why they are stressing the equities, resulting in lower results. Because I think for most companies, if you allow moving from sterling to GBP, you get a negative results. So I think they're probably seeing the size of negative results by shortening the period. But again, this is speculation on my part. Other comments?
Yeah, speaking on the normal stress on the slowdown plan, wanted to understand because we need to measure the market sensitivities to the short on due to stress. So wanted to ask what are the specific stresses that I have. And also the stresses will be different based on the control process.
So the liabilities will be all the stresses apply on the liability. Your I guess it's related, right? So I think you've got your usual all that will apply. And then market risk will apply on your unit funds. And that has a knock-on impact on cash flows. Not sure that I'm answering your question. Yeah, so that's based on your unit funds. So if your unit fund have any equities, they track it is charged. So it has to be on a monthly basis as well. So yeah, it depends on your unit fund. So maybe if you can share the market risk charge.
I think you probably confused because you model your unit funds in single funds in your model. No, but if you model it separately, say if you split up, if your model is able to identify that this fund is identified, that fund is a support fund, then you for equity is straightforward 30%. Then for the bond, just for that particular bond, you just apply the stresses based on the individual bond component. So not sure what's the conclusion. Each of the yeah. Any question? Yeah.
I will tell again. So for the ORCT account base is using management expense as exposures. So say if my company invested a lot of expenses in improving accuracy, I already have lower profit. But then at the same time, I'm being charged higher ORCC for spending money on improving my company process accuracy. Isn't it a bit double counting on the cost of the expenses? So I will having lower profits and higher charge for having a project to improve my reporting accuracy.
Yeah, I mean, this one I think is a bit tricky. I mean, on average, we see compared to a 1% asset value, using this should for most company on average would be a reduction. But I think the point that you make is valid. You are actually making improvements, but yet you're being penalized for your improvements. I think it's a point to raise to Menara.
Thanks.
And one question for it's in January, it charged the same. Thanks. First of all, thanks, Milliman, for facilitating this session. I've been very mindful not to ask the question as if you're married. So that's why I'm trying to maintain the clear separations. All probably after question we should post in the thanks for the facilitation. Where I'm coming from is that based on my observations, generally we see higher recharge being applied response to all these topics. The other hand, we see this diversification being introduced as well as the potential leaders for grassroots intervention level with over 5%, as well as few other changes. Based on minimum expectation as well as probably some assessment that we cannot know what is the cost. Results potentially will look like compared to the current subsidy, for example. I'm not sure whether you expect to get worse or better or fully neutral. We can comment on that.
Yeah, I mean, so we've got to sort of jump back to the end, but I'll address. I think that's the question that everyone's asking. Right? That's what does it all mean? So we saw in Singapore when they introduced RBCT, we saw all the discharges went up. They had diversification benefits. Actually, it landed more or less the same area or even slightly lower. So the question is that going to happen to Malaysia as well? It's a bit harder for us to do this assessment because in Malaysia, all forms of public school actually promote on populations. But I think initial assessment, it really depends on products. I think initially what we see, I guess from a Takaful perspective, most countries typically have a big block of credit business. So credit business, we see things like TCR for mortalities come down, and then you've got diversification as well. So that actually might look potentially might look better for companies, but it also depends on the SPCC. Is it SPCC right or not? So because now that's moved from SPCC to just the mass lapse, which I think on average should be a lower impact compared to SPCC. So I think overall it might look better on of adequacy. So that's our initial assessment. I don't know whether you have done the internal assessment and we come up to similar conclusions. That's what we see. I think I'll talk about impact on the company level maybe towards the end, but essentially it really depends on products.
Our question is on the insurance and Takaful choice. So, in the new policy document, there will be no difference between whether the contributions are guaranteed or not, right? Because the same factor is factor will get up. So, is it in this direction? Is it are we seeing the same risk between whether the contributions are guaranteed or not? So, companies to adopt just the premium contributions to be I think to
I honestly think it really depends on the mix of business. So I think for mortality, for most companies, they're guaranteed. So it's really dropping from 40% to 25%. I think the question will be on morbidity, right? For morbidity, I think for most companies, the CIs are non-guaranteed, so that's going to be a big increase. So ultimately, does your company have a big block of morbidity? Business is non-guaranteed. That's where you will see a rise in risk charges. So, and similarly for medical payments as well. Medical payments, I think, is not very big compared to morbidity of illness.
what I'm trying to say is that increasingly if I write guaranteed slams, I will not actually increase the time.
Correct. So maybe it's opportunities for Takaful players to offer, guaranteed basis. But I mean, I think in reality, we know that doesn't, really exist. Correct. I know in Asia, there's not really been repricing of CI, but in the parts of the world, it's already happening. So I doubt that more guaranteed CI is coming through just because I think factories will actually understand the inherent risk. Other than this, what we're seeing is more impact the management.
Any other question? Otherwise, we move on to the section. So, in this section, we talk about the changes in the DCA. So, this is just a high level view on what is the component in the tier 1 capital. So, a few noticeable changes is that 50% of the future bonus for the PAR is now gone. And in the new RBCT, there's a new component called regulatory adjustment, which is the 100% or 50% of the negative reserve depends on the insurance funds. So in terms of tier 2 capital, there's you can see that the AFS and the valuation reserve is now gone. It's actually moved to the tier 1 under the other OCI. Then the restriction on the tier 2 capital is within unchanged. So for example, the subordinate debt is still capped at 50%. Then the total amount of tier 2 capital is still capped at the tier 1 capital. Then the deduction allowed for under the RBC1 and the RBC2 are still the same. So including the bill, PPA, SAD, etc. Yeah, so one key change is what in the exposure type is called the regulatory adjustment, which is the recognition of the negative reserve as part of the DCA. So for PI, you are able to recognize up to 100% of the negative reserve as your DCA. But for the shareholder fund, you can only recognize up to 50%. Then there is another thing changes is on the capital available that you can recognize in the Takaful risk fund. So under the current RBC, you can recognize the capital available in the risk fund up to 130% of the risk required. But under the current RBC, you can only recognize up to 100% of the risk required for the Yeah, so this one.
This is the point that the gentleman at the back raised, if you don't actually reserve for your surplus, you actually can make, need to make, an adjustment to your TCA. So I think the TCA is just quite short. I think that some of the key takeaway from a Takaful operator perspective is that we've got your 130% previous capital available, capped at 150% par. That's now dropped to 100%. So I know previously the industry was lobbying to increase that to ITCL. What we've seen now is a reduction to 100%. So let me pause there first. Any comments, observations on TCA before we move on to the next section? Okay. So we've tried to really give a very, very high level summary. You take this with a pinch of salt because I think it can depend on your product. So we do see, I think firstly ILP, companies do have ILP blocks, so it was blocked. So you will see negative GBP coming by, GBP reserves coming through typically. We see this issue around despite your TCA increasing, this is what negative GBP. For your PRF funds, you're still capped at 100% of your TCR. Okay, so that's a drop, as I mentioned earlier. Market risk, we said increased, and also applies to your unit fund for your investment business, applies to PIF. So again, that's a big change. The Takaful discharge, again, that depends on your products, but likely to increase. For example, if you've got your unit-linked business now, before it was for sterling reserves, now you're more sensitive to changes in lapses, attributed to mortality. We expect credit discharge to be, in fact, to be minimal on average in terms of quantification type. But I think effort would be a lot more trying to determine that. Operational risk likely to reduce, again, on average. And diversification benefit should help to bring it all down. I guess the question then for companies, we see likely that the CAR will reduce, but I think the question you should be checking as well is your reduction greater than 30%. And why is the 30%? Is because of the 130 to 100. That's the adjustment that the regulator is changing in terms of solvency intervention. Is your changes more than 30%? Some companies we have done our own assessment and sense check in, some are lower, some are higher than 30%. So I think that's something that's important to check. So we mentioned about not only numbers but also implications to the work that's involved to produce these numbers. So modeling impact and so operational impact. One sample already mentioned about having to look at assets on a more granular basis, especially bonds and CIS, making those adjustments for each bond, which is different for each fund. So that's a lot of work for the finance team, especially for ILPs as well. We have different stress tests that may be applied to the unit funds. So companies model it by different unit funds. You are able to apply different shocks. If you do simplification, then maybe you need to look at accounting or models. So you've got the discussion about medical riders as well, the repricing. So there are others also things on the profit modeling or the actual valuation modeling. All that will require changes. How you model your stats and your EV on the projected capital will also need to change because you've got diversification benefits now. So you can't do diversification benefits for policy level. It doesn't really make sense. That all happens at the fund level and company level. So to rethink all that. And then we see lapse risk actually becomes more material for IM. So I think next steps is really companies having to identify areas that's unclear, areas that you would like to challenge, push back. So thank you, ma'am. You're absolutely right. We are not representing BNM. We are helping to facilitate discussion at the industry level. I think it's I think we're all in it essentially. And the discussion will only benefit all of our industry, which is the reason that we are here today. So I mean areas, some already mentioned this morning, or areas where it's unclear or pushback, but maybe I can add. The first point was on the determining best estimate liability. So there's no matching adjustments about the adjustments because companies that she's too complex and even so let me share what happened in Singapore. So matching adjustment was also introduced in Singapore, and there were not many companies as well. Didn't think they did. But what happened after RBC was implemented, after the assessment in 2021, 2022, market tanked. Yeah. And then companies were scrambling on how to improve their capital position because companies they were seeing like solvency was approaching. So they actually used matching adjustments to help with their capital position. So I think it's something that's worth discussing as an industry, whether we still need matching adjustment. I think when the market is well and good, right, but would it be helpful to have that lever industry if interest rate has now need that extra bit just to help your solvency position. Matching adjustments can help you with that. So I just want to leave that for God, because I think we've got to think in stress conditions, not just in the conditions. Otherwise, that we saw as well is around management actions. So a lot of management actions that was mentioned in the paper was around medical business, medical repricing, and for power was from bonuses, and also on the surplus of Takaful. But I think that it was quite silent on universal life, for example. I know there's not a lot of universal life in Malaysia, but the question is, predictably, we also be subject to management actions for companies with universal life. And I appreciate it's a small block in Malaysia. I guess the question is also whether as industry should we try to push back from this 100% intervention to allow ITCL. I know it's been probably a decade-long debate and request to Bank Negara, but it is still worth the request. I think there's no harm. Okay, so I'm sure companies are now busy with sort of impact assessment at product level, company level. They do take time, but I'm sure there's some initial impact that you already see. Companies are starting to think about phase 2 and what model changes they need to do. And I really mentioned about areas to identify, to log into the Bank Negara. And then companies need to think about what does it mean in terms of your product strategy, right? Do you sell more guaranteed CI, for example? That's what Patrick mentioned. So that affects your product strategy, business plan, all this is the RBCT impact, as well as your BNM impact. Like GPP, how do you change that? So I've just got one last slide to see how we can help. It's just FYI. I think we want to focus more and see it at the industry level. So there's some areas we can help. For example, collating feedback and questions. The second part is we also look at aggregating phase 2 results. And usually, phase 2 results just submitted to Bank Negara and they don't hear back. Get someone much time. But if you feel that it's benefit to looking at phase 2 numbers aggregating industry level, and not just Bank Negara to do this, that's the big. So I'm going to stop there. Any questions or comments?
Residents, over doubts, the event within, please take this opportunity to ask the text.
Hi, I would like to circle back to just now the looping because I saw the website there's a looping change is required. And earlier, after the first session, I think you mentioned that you changed to the follow run that we are doing because of the HRG changes. But my understanding of the HRG part is more on the guideline. You mentioned that HRG is for the central estimate liability when you set up your assumption for the risk group, and also as part of the stress where they mentioned that your stress by lapse should be determined by the HRG. So my interpretation is that we no longer need to do like the last time FCC when we have to stress to get the highest FCC by the follow. So is that means that because under the first section is quite big also to mention like how we should set up here. It's just a very general process. Is it means that we can still retain like what we're doing now?
I think for web, yes, there's no requirement change. You can return if you want. The looping is mainly for the new stresses. So for example, now you have the active stresses. So in your step one, you will need the active stresses. Then of course you also need the credit risk stresses, the on-house stresses. So the looping will be got more. So maybe what you narrow it down is 4+4+1. And I'm obviously some signification of this type. But obviously, moving to RBCT, it will be, for example, if you get the certain change the volumes, then one loop for then a couple of other loop for the instances.
I see. Okay, that's what you mean by the looping inside. So we can buy one.
Yes, then separate ones.
Then back to they mentioned a lot about NAV asset minus liability for all the stresses. So for particularly for the family takaful risk charges, right? Is that only the liability need to be stressed because there's no asset on the stress except for cat risk where you would assume like an immediate increase in the death rate, so there will be asset side and pay out claims, and you also at the same time you reduce your liability. Is that the correct understanding?
That will go back to how you plan to do the EIF, how you plan to do the surplus calculation. So for example, if you are doing it in Excel, then you might have the set. For example, you have the bond inside, then of course it's short bonds.
Okay, maybe be more specific like for monthly rate. So stress, you have to stress the amount up. Is the NAV that I mentioned there is mainly will stress on the liability only because there's
For insurance risk only for
insurance. Yeah.
Any other question?
As your views on the adjustability.
Yeah, okay.
Okay, so because in the exposure chart was see that the adjustment is split between the MFRS 17 that we have already adopted against the exposure chart adjusted with the earnings. So I'm not very sure what are the objectives of between that adjusted and disadjusted.
For me, I think that's to get the variation surplus under the stat basis. So obviously you cannot take the surplus under the IFRS 17 basis for RBCT. So the quickest way to get a similar variation surplus is just to replace the IFRS 17 total liability with the stat total liability. Then you will get the adjusted.
So in a way, every company have to maintain two sets.
But that's why with the shortcut you don't need to maintain. That's my view. Any other question?
Just now, Milliman mentioned that there's a modeling complexity in calculating a future surplus. So I would want to clarify because based on my understanding, the gross central estimate actually it should calculate at the certificate level subject to the homogeneous risk group or whether there's a similar risk driver or surplus participation. I just want to check whether if let's say we calculate surplus at the higher risk group level, even at fund level, and allocated back to the policy level, will this still meeting the guideline on under the ED?
It should.
I think this is the challenge where you see neutralization, because I think ultimately when we declare surplus, we always look at surplus at the fund level, which may not add up to that policies. So I think that's where the mismatch is happening. Just looking purely policy level, it may not add up to a fund level. So that's the awareness that we need to have, because as a margin actuaries, when you declare surplus, you look at the fund. Final thoughts or comments? It may not have to be a question, but anything that you want to share with the group here as well is also very much welcomed. Yes, I think I've already presented at the last one.
I on the discount rate, because Bank Negara mentioned that the industry opinion is to not have the liquidity premium or the margin adjustment or the adjustment. Say if this is something that we want to consider, and then on the other side of the loss spread risk, because that one we just need to stress the assets. Will there be a consideration by Bank Negara? I mean, just to get your opinion. That if we were to adopt a liquidity premium, that we might need to stress the liability side of supply spread, because the liquidity premium is taken into account.
Hard to say, but I think it's quite uncommon to expect the if very feeding again like what I said.
Thank you. Maybe just want to get from your point of view, because currently if we look at the RBCT framework and the IFRS, right, it's totally different, you know. It's almost like you're gonna manage two different groups of business and your management decision may be beneficial for things but not beneficial for the other part of it. Now with this change to RBCT more like your point of view, how much is it getting it closer? Is it more aligned? Is it aligned between the RBC2, how we look at business from RBC2 basis and IFRS basis? Because I mean, previously when we were in the IFRS 4 and RBC, it's actually almost the same results in RBC. Here are some of the results in IFRS 4. It's actually the results in RBC. So, but now it's changed. Just one person getting early views in terms of how much goes to the line.
I think that there is some aspiration from what I understand was trying to get it closer. So, for example, moving the study basis to GP. That's one of it. But I think you can't get it perfectly match because
things like discount rates, we know very circumstances to all of that. I think you mentioned a good point about having multiple things to report on. You've got RBCT, you've got IFRS 17. What we see then, I think, is actually back to the company's eyes, metrics, how do you make the decisions, how do you manage your BNM, statutory basis or IFRS 17 basis. So we see a lot of movement around metrics, KPIs, region now, and these some are quite sophisticated in different regions, to different components. Usually people do try to track everything. Some have just gone only for one metrics, that as well. I think that actually will have implications on how you run your business. I mean, when we see sort of, I mean, we do a lot of M&As, for example. We get a lot of questions on, can you do valuation on that basis on top of like the normal? And I think what we see from the reports, financial EIAs, they're still reporting on a monthly basis. And again, some research in Europe, we find that standard reporting is still tricks. But it's a developing landscape.
I guess more challenges. Currently, I'm maintaining to have less for contents than others. So looking at it, it seems like we need to 3 groups. That's RBCT and some people.
From 2026 for 1 year, since we've been reporting. So you got RBC 1, RBC 2, 2026, after 2 months and everything.
I mean, yeah. So for that, it's on this. So we have that 3 teams with those 3 groups.
So I think that's also implications on your resources, right? Because you've got all this to produce, which is not small things. Right, yeah. So as Dean pointed out, there's also other bits like the climate risk stress testing and scenario analysis and all the quality and all that stuff. Questions. I just wanted to thank everybody for your time this morning. I personally really enjoyed the conversation. Many observations made by everybody here. I think we're all learning this together. So thank you very much for your time. Have a good day. Thank you again to everyone for attending. Thank you for attending this workshop. I hope that this workshop has been beneficial for all of you. It's not very long, but I think that we have all understood and sought clarification for whatever we did not understand what was presented by Milliman. And the last thing I would like to say is thank you again to Milliman for conducting this workshop for us. This is the family one. Next week, there will be another workshop for the general Takaful industry. Thank you very much, Fazana, Marcel, and thank you very much. And then for the rest of you, thank you for attending and the safe trip back to your office.